The market died years ago. Yet, the green numbers climb. In a windowless basement, one server hums. It does not calculate wealth. It sustains a corpse. If the illusion breaks, what remains? We are trading ghosts, kept alive by 3 invisible pillars. Look closely at the screen in front of you. The numbers appear real. They flash in neon greens and deep reds, ticking upward with mechanical, heartless precision. The mainstream financial media calls it a historic bull market. Your broker calls it a golden age of wealth generation. Your retirement planner calls it safety. But if you step outside the glowing terminals and look at the real world, you will see a completely different, terrifying reality. Main streets are quiet, lined with empty windows and shuttered storefronts. Corporate bankruptcies have quietly climbed to levels not seen since the height of the 2008 global financial crisis. The average consumer is drowning under a mountain of credit card and auto debt that grows larger with every passing second. And yet, the Nasdaq and the S&P 500 regularly touch new, breathless, all-time highs. How do we resolve this paradox? How can a house stand when its entire foundation has decayed into dust? The answer is simple, yet deeply unsettling. It cannot. What we are witnessing is not a healthy, growing economy. We are trading ghost assets, digital contracts that exist only as algorithmic liquidity, entirely severed from real-world economic value. If you believe you are investing in the productivity of human innovation, you have been sold a beautiful lie. You are merely trapped inside a self-reinforcing, synthetic loop. This video is not a generic doom and gloom warning. It is a highly practical operations manual designed to help you peer behind the curtain. We are going to dissect the 3 invisible pillars holding up this system. We will show you exactly how the world's most powerful institutions are quietly preparing for the exact moment the master switch is pulled. Because when this illusion shatters, paper wealth will not just decline, it will vanish in a matter of milliseconds. Only those who have transitioned their wealth from digital ghosts to physical reality will survive. Let us begin by looking at the first pillar, and the 7 giants carrying the weight of a dying financial world on their backs. The modern stock market is built on a grand statistical lie. It is the lie of averages. When you buy a standard index fund, like the S&P 500, you are told that you are purchasing a diversified basket of the 500 strongest, most resilient companies in America. You are promised safety in numbers. You are told that if a few companies stumble, the rest will carry you forward. This is the cornerstone of modern portfolio theory. But if you open the hood and look at the engine of this index, you will find something deeply broken. The S&P 500 is no longer an index of 500 companies. It is a cleverly designed disguise, worn by just 7 mega-cap tech stocks. These 7 giants now represent nearly 30% of the entire index's value. Think about the sheer absurdity of this. You believe you are diversified across the entire American economy, from manufacturing to retail to energy to healthcare. But in reality, nearly a third of your hard-earned money is concentrated in just a handful of Silicon Valley tech giants. Behind these glowing neon pillars, the other 493 companies in the index are in a silent, structural depression. If you remove those 7 stocks from the calculation, the market's historic, record-breaking climb completely vanishes. It becomes a flat, declining line. We are measuring the health of an entire forest by the height of its 7 tallest trees, completely ignoring the fact that the soil underneath is dry, depleted, and dying. This concentration of capital has reached levels not seen since the peak of the 1929 bubble, right before the Great Depression. It is an unprecedented, systemic centralization of risk. Now, ask yourself the contradiction they do not want you to face. If you bought index funds to diversify and minimize your risk, why have you actually centralized your entire life savings into a highly concentrated bet on just 7 hyper-exposed tech companies? What happens when one of these 7 pillars experiences a sudden, catastrophic shock? A sudden, unexpected geopolitical conflict that halts microchip production in Taiwan. A sweeping regulatory crackdown on artificial intelligence that wipes out trillions in projected future earnings. or a simple, systemic database failure. Because the entire global financial system is resting on their narrow shoulders, a single crack in just one of these companies will bring the entire temple crashing down on the heads of those below. The average investor has no idea they are standing on a single point of failure. They look at their rising portfolio value and feel safe. They believe the index is a safety net. In reality, it is a high-altitude tightrope, and a storm is rolling in. But to truly understand how we reached this point of extreme centralization, we have to look at the second pillar. It is a massive, automated machine that buys stocks completely blind. And it was created by the very man who tried to save retail investors from Wall Street's greed. For the last 3 decades, passive index funds have been sold to the public as the ultimate financial miracle. The pitch is incredibly seductive. They require no active management, they have virtually zero fees, and they consistently beat the professional stock pickers. All you have to do is set your automated monthly contribution, look away, and wait for retirement. It sounds like the perfect system. But this simple advice has quietly birthed a systemic monster. Passive investing has completely broken the fundamental mechanism of the free market: price discovery. In a healthy capitalism, investors perform a vital public service. They look at a company's balance sheet, its earnings, its debt load, and its management team. They buy the undervalued, well-run companies, and they sell, or avoid, the overvalued, poorly managed ones. This constant push and pull of active analysis determines the fair price of a stock, ensuring capital flows to where it is most productive. But index funds do not analyze. They do not think. They do not care if a company is highly profitable or if it is a zombie corporation on the verge of bankruptcy. They simply buy. Every time a portion of your paycheck is automatically deducted for your retirement plan, fund managers like Vanguard, BlackRock, and State Street are forced by their own rules to blindly purchase shares. And here is the paradox. They buy more of the biggest companies simply because they are already the biggest. This is a permanent, self-reinforcing capital feedback loop. The larger a company's market cap, the more index funds are forced to buy it. The more index funds buy it, the higher its stock price goes, making it even larger, which forces the index funds to buy even more. It is an infinite spiral staircase of computer monitors, each displaying the exact same stock chart, looping forever into the sky. This loop has removed the brakes from the train. It has created a world where valuation no longer matters. A company can lose billions of dollars, but as long as it is part of the index, it will receive a steady, automated stream of new capital from millions of unsuspecting savers. Wait, what is the ultimate irony here? The index fund, marketed as the ultimate populist tool to protect the average worker from Wall Street, has actually become the very weapon stripping the market of its intelligence, turning it into a blind bubble machine that will trap those exact same workers when the flows reverse. In 2016, the late Jack Bogle, the legendary founder of Vanguard and the father of index investing, issued a quiet, chilling warning that the financial media quickly swept under the rug. He warned that if index funds became too dominant, they would destroy the stock market itself. He saw that a market without active buyers and sellers is no longer a market. It is a blind, mechanical distributor of capital. Today, passive funds control over half of all U.S. equity assets. We have crossed the dangerous tipping point that Bogle feared. So, what happens when this blind buying loop suddenly reverses? What happens when the massive baby boomer generation starts retiring in record numbers, transitioning from buyers to forced sellers? What happens when the flow of new retirement money stops? If there are no active, value-conscious investors left in the market to determine what a stock is actually worth, there is no floor. When the massive sell orders begin, the automated machine will blindly sell everything, and the descent will be twice as fast as the ascent. There will be no one standing below to catch the falling knife. But there is a reason this house of cards has not collapsed yet. Whenever the market begins to slip, a hidden hand reaches out of the shadows to steady it. And its power is absolute. In October of 1987, the global financial system looked into the abyss. On a day known as Black Monday, the Dow Jones Industrial Average plummeted by over 22% in a single session. It was a terrifying reminder of how quickly human confidence can evaporate. In the quiet aftermath of that crash, the United States government realized that a truly free market was far too dangerous to be left to its own devices. They decided that the market must never be allowed to fail again. To achieve this, President Ronald Reagan signed Executive Order 12631, establishing a highly classified, ultra-powerful entity. Officially, it is called the Working Group on Financial Markets. But within the quiet hallways of Wall Street, they are known by a much more visceral name: the Plunge Protection Team. This group consists of the ultimate insiders of the global financial architecture: the Secretary of the Treasury, the Chairman of the Federal Reserve, the head of the Securities and Exchange Commission, and the head of the Commodity Futures Trading Commission. Their mission is as simple as it is absolute: to prevent market panics at all costs. So, how do they actually operate? When the market starts to tumble and a wave of panic selling begins to build, this team does not issue press releases or make public speeches. They operate in the dark, liquid depths of the index futures markets. By purchasing billions of dollars in stock futures contracts during critical moments of capitulation, they synthetically force prices back up. This artificial surge triggers massive short squeezes, forces high-frequency trading algorithms to stop selling, and instantly restores the comforting illusion of stability. To the public, it looks like a natural, miraculous market recovery. In reality, it is a state-sponsored intervention. But this leads us to a devastating contradiction. Capitalism is celebrated for the creative destruction of failing assets, yet the state spends trillions of synthetic dollars to ensure nothing ever dies, fundamentally destroying the very free market they claim to protect. How can you trust any asset price when the referee of the game is secretly playing with a marked deck? This constant intervention has created a toxic psychological environment known as the Fed put. Modern investors no longer fear risk because they believe the government will never allow the market to go down. The stock market has been transformed from a place of capital allocation into a high-stakes state casino where the house guarantees you can never lose your bet. But this permanent safety net is a dangerous illusion. The immense wealth used to save these markets does not come from thin air. It is conjured out of nothingness by the central bank, diluting the purchasing power of every single dollar you work for. They are saving the stock market by systematically destroying the purchasing power of the currency. And here is the ultimate twist. While these institutions keep the digital scoreboard flashing green to keep the public calm, they are quietly moving their own wealth out of the very system they manage. They are trading their paper promises for something very heavy, very quiet, and very real. There is a massive, quiet hypocrisy at the heart of the global banking system. For decades, central bankers and mainstream economists have told the public that digital assets, sovereign treasury bonds, and stock markets are the safest, most sophisticated places to preserve wealth. They dismiss gold as a useless, primitive relic of the past. They tell you it is a dead asset that yields no dividend, a heavy metal fit only for the history books. But you must pay attention to what they do, not what they say. Behind the heavy, reinforced doors of the world's financial capitals, central banks are currently purchasing physical gold at the fastest, most aggressive rate since 1967. To put that in perspective, 1967 was the exact year the London gold pool collapsed, signaling the imminent demise of the global gold-backed dollar standard. The people who print the money are behaving exactly as they did right before the last great currency collapse. And they are not buying paper gold. They are not buying gold exchange-traded funds or digital certificates. They are demanding the physical, heavy bars. They want it delivered directly to their deep underground vaults, far away from the banking system. Think about this mind-bending contradiction. The very institutions whose sole job is to issue, manage, and defend paper currencies are quietly dumping their own fiat paper to hoard heavy physical gold. Why are they doing this? Because they know how the game ends. They know that their currencies are melting ice cubes, destined to lose all value. They know that the digital stock market is an unstable, synthetic simulation held up only by a fragile web of algorithms and state interventions. And they know that when this simulation inevitably fails, physical gold is the only asset in human history that carries zero counterparty risk. Gold is the ultimate financial truth. It cannot be printed by a central bank. It cannot be wiped out by a server error or a sudden cyber attack. It does not require a password, a high-speed fiber optic connection, or the permission of a clearinghouse to exist. While they encourage you to keep your life savings locked in digital accounts, subject to the whims of inflation and algorithmic volatility, they are quietly building a foundation of physical reality. They are preparing for a massive, global monetary reset. They are sweeping the paper off the table, ready to reveal the solid, golden floor beneath. And the fuse that will trigger this transition is already burning. It is coded into the very algorithms that execute nearly every trade on Earth. The modern stock exchange is no longer a human environment. The chaotic, shouting trading pits of Wall Street, the iconic images of traders waving paper slips and screaming orders, are dead monuments to a bygone era. The modern trading floor is silent, cold, and dark. Today, over 90% of all daily trading volume is executed by automated algorithms. These are complex mathematical formulas running on high-frequency server racks located in unmarked buildings miles away from New York, connected by dedicated fiber optic cables. These machines make decisions in microseconds, thousands of times faster than a human can blink. They do not read newspapers. They do not care about a company's product quality. They do not feel fear, greed, or hesitation. They are programmed to react to momentum, moving averages, and technical liquidity pools. And because almost every major financial institution hires engineers from the same elite schools, these algorithms are all built on the same core logic. This has created a dangerous, fragile uniformity in the market. When prices are rising, the algorithms buy together, creating an artificial, rocket-fueled upward momentum that has nothing to do with real economic growth. But when prices drop below key support levels, the program shifts instantly. Suddenly, the algorithms are triggered to sell, and they will sell together. This is the algorithmic kill switch. It is a sudden, automated sell-all cascade that no human being can stop or control. If the market drops below its critical moving averages, the computers will instantly flood the exchanges with millions of sell orders in a fraction of a millisecond. But here is the catch, the terrifying paradox of modern liquidity. We built these high-frequency systems to provide infinite liquidity to the market. But in a true moment of panic, these algorithms are programmed to instantly pull their bids to protect their own capital. The buyers disappear in a flash. When the computers decide to sell everything in microseconds, how do you exit a market where there are no human buyers on the other side? The simple answer is, you cannot. Your retail brokerage app will display an error screen. The exchanges will trigger circuit breakers and halt trading. But behind the frozen screens, your paper wealth will have already evaporated into the digital ether. This is not some distant hypothetical nightmare. It has already happened in miniature form during the flash crash of 2010 and the repo market crisis of 2019. Each time, the plunge protection team rushed in to patch the system. But one day, the wave of automated selling will be too massive for any central bank to absorb. The servers will hum their final desperate note, and the screen will go black. So, how do you protect yourself before the plug is pulled? The answer lies in the playbook of the ultra-wealthy. When the digital music finally stops, where will you be standing? The world's wealthiest individuals, family offices, and sovereign wealth funds are not waiting for the crash to happen. They have already designed and implemented their survival playbook. They are not trying to time the market, and they are certainly not looking for the next hot tech stock or speculative digital asset. They are systematically restructuring their entire portfolios to eliminate one specific, invisible danger: counterparty risk. Counterparty risk is the hidden threat that the other party in a financial contract will fail to fulfill their promise. When you own a digital stock or an index fund, your wealth relies on an incredibly long, fragile chain of counterparties. You rely on your broker to remain solvent, the exchange to stay online, the clearinghouse to settle the trade, the banking system to transfer the funds, and the underlying corporation to remain profitable. If a single link in that complex digital chain snaps, your wealth is instantly frozen or destroyed. It is a risk most investors do not even realize they are taking. True wealth preservation requires holding assets with zero counterparty risk. This is the cornerstone of the sovereign wealth playbook. It means holding physical gold and silver in private, secure vaults outside the commercial banking system. It means owning prime real estate with clear, physical title. It means owning hard commodities that are absolutely essential to human survival, such as energy assets, agricultural land, and critical physical infrastructure. Consider the ultimate paradox of our time. To survive the ultimate high-tech, digital-first financial collapse, you have to regress your entire wealth strategy back to the most ancient, low-tech, physical systems of the past. These are assets that do not require a password, a functioning internet connection, or the permission of a counterparty to have value. They are physical, tangible, and indestructible. To build your own wealth fortress today, you must step off the digital tightrope. Stop viewing your wealth as a fluctuating number on a smartphone screen. Begin by converting a meaningful portion of your paper profits into physical reality. Secure physical precious metals that you can hold in your hands, or store them in specialized private depositories that have no connection to Wall Street. Reduce your exposure to blind, passive index funds that are inextricably bound to the algorithmic loop. Reallocate your capital into tangible goods that possess intrinsic, real-world utility. This is not a strategy to get rich quick. It is a strategy to remain wealthy. It is about ensuring that when the digital servers fail and the paper wealth of millions is wiped out, you hold the physical keys to real-world value. It is about choosing the quiet stability of reality over the flashing, unstable simulation of the market. The smart money has already crossed the bridge, and they are preparing to pull up the planks. The only question left is which side of the river you will be on. We have spent decades believing that wealth is nothing more than a green number on a screen. We have trusted our futures, our retirements, and our family's security to silent servers we will never see, managed by algorithms we do not understand, and backstopped by institutions that are quietly packing their bags and leaving the building. But the laws of mathematics cannot be suspended forever. The green numbers cannot climb to infinity while the real world decays. Eventually, the server in the windowless basement will run out of power. The illusion will shatter, and the division between those who hold paper promises and those who hold physical reality will be absolute. Do not wait for the screens to go black before you look around. Look at your hands. Look at what you actually own. Stop trading digital ghosts. Start building a fortress of real, physical wealth while the doors of the system are still open. Because the hum of the server is growing faint, and when the music stops, only the physical will remain.